Hello and welcome. You're watching Last Take. I'm Shweta Kothari. With me is my colleague Krishna Kumar. Krishna, very good afternoon. Quickly running our viewers through the markets action this afternoon. Markets, both Nifty and Sensex, ending in the red.
Right, they both opened in the green. If you remember correctly, you had both the Sensex and the Nifty and the mid cap and the small cap indices all opening in the green. Bear in mind, they opened in the green based on the cues that they got from global markets, US markets closing in the green, Asian markets were up, and they began on the right note. But what needs to be noted at this stage is Nifty is just a tad below that 21K peak that it scaled. And take a look at those Asian markets that have closed for the day as well. Quickly, the Nifty at 2906, just shy of the 21K mark, and the Sensex too, 500 points, 450 points below the 70K mark. So 0.5% in the red for the Nifty Sensex and the Nifty mid cap. But take a look at that small cap, Shweta. I mean, there is nothing that seems to be affecting the small cap index. You know, on a day in which the broader indices end in the red, it's in the green. The day in which Nifty Sensex end in the green, it continues to be in the green. Yes, not much gains as far as Nifty small cap is concerned, but 0.5% point drop at this stage, I think, would refer to some kind of profit booking, because let's not forget the kind of run-up we witnessed.
Best weeks, last week's perhaps one of the best weeks for the markets in over a year. So all of that has resulted in some sort of profit booking that we are seeing in the markets today.
If we can just take a look at the Asian markets as well, Shweta, because the Asian markets, it's a sea of green over there. Take a look at that. Hang Seng, Shanghai Composite, Nikkei and Kospi, which is Hong Kong, China, Japan and Korea, all of them about 0.5% to 1% in the green. And bear in mind, these Asian markets obviously opened before the Indian markets do, and they were directly taking the cues from Wall Street. Wall Street closing in the green simply because of a very peculiar reason. No bad news. No bad news for stock markets in the US is good news for Wall Street. What is meant good for Wall Street is meant well for Asian markets as well. But strangely, Indian markets, which have been Teflon coated to global uncertainties and what's happening across the world, today ending in the red, but we'll have to wait for our special markets guest to help put those closing numbers into perspective for us.
All right, absolutely. Let's get in our guest, Rohit Srivastava, founder and market strategist, India Charts, joining us on the show. Rohit, good to have you back. Very good afternoon. What are you making of Indian markets snapping some of their winning streak over the course of last 1 week, ending 0.5% lower today?
Well, the drop is not significant if we just look at today. Markets have mostly been flattish, and the fall doesn't even go below, say, the hourly moving averages. And so therefore, it's not yet significant, but we should be careful. We are, slightly overbought. If we look at certain indicators, there are divergences in momentum. Participation has become very, very narrow. We aren't seeing a broad-based advance in the market. So a lot depends on the rotation simply going on from one sector to the next and we are also going into what will be a slightly more holiday-ish period as we go into the second half of December, because that's what people do. They all just go on holiday.
Absolutely.
The one question I want to ask you is this. Now, you're looking at the Asian market, they're all in the green. US markets had a good close on Wall Street. After all those green cues, how come it's possible that Dalal Street didn't exactly go the green way today?
Well, we don't always correlate on a day-to-day basis, but even if I look at, say, Europe, that's been going up one way today. Also, the CAC's, up pretty much. And if you look at the RSI, 84, 85, making it look extremely overbought. So some of these markets are probably running up because maybe they didn't run up so much earlier. But there will be a lead lag. I mean, the topic process is never day to day. I think the markets are staying up essentially as we head into the Federal Reserve meeting, right? That's the most important event of the week right now that everybody's eyeing. And the funny thing is, the markets have already rallied ahead of that event or are still steaming ahead of that event, which means that a lot of whatever he may be about to say or about to do is already priced in. So the chances of a late month sell on news kind of correction is very much possible.
All right. So are you suggesting that the markets have already priced in, the movement has already priced in what has come by the way of election season? And also, what are going to be and likely to be the major triggers today and tomorrow? So in the short run, India will come out with its CPI inflation numbers. US is expected to come out with its inflation numbers. That could, in fact, some hamper the bulls' rally in a way, Rohit, in a couple of days from now. So are we looking at consolidation in the near term?
I would think so. Consolidation or correction, or does it become a trend reversal, are three separate questions. And I'm keeping all of them open. I know if you want to be hardcore bullish, you'll just say consolidation. But I think a lot of the risks that were there, say a month or two back when the markets were down, have really not gone away. They've just been postponed by the news flow, which is that inflation data continued to drop, which it anyway was doing earlier, but the market was not sure because bond yields were, still rising. Now that bond yields are falling, that has sort of given markets a comfort that possibly the falling inflation data can be sustainable.
Okay.
But we don't know that for sure. There's enough research out there that tells me that inflation for even 2024 may not go significantly below 3%, and which means it may remain stickier for longer, making it very, very difficult for interest rates really to come down. We may pause, but we may not really see a significant cut in rates, and any cuts will only happen in the later part of 2024. So what does that mean eventually? Because you already have parts of the global economy slowing down. If you look at US manufacturing PMIs, they are all sub 50. It's just the services that has held on, or rather not even services, consumption that has really held on. So it's a tricky mix. If you look at some things, they look very strong. If you go by GDP data, 4%, it looks like, oh, all is great. And then if you look at some of the other factors, they have really not changed much to say that you're out of the woods. It's just that they got postponed, but they will come back to haunt us in 2024, which is why you need to be open to the idea that, is it a consolidation? I think we figure it out as the patterns develop. If it does result in a consolidation, we can happily remain more bullish, and consolidation should mean not falling, say, below 20,500, or that election gap that we really had closer to 20,000. Yeah, that's around below 20,500. So if that gap is held, not filled, it can still be a consolidation. But if we do go below that, then it will end up looking like a slightly more medium-term correction for our own market. One of the risks I would like to highlight for our own markets, and I probably mentioned it last week also, is the USD INR itself. For some reason, we have a currency risk that is not being really talked about. I think the RBI is really managing it in a narrow range, because the USD INR is really not moving more than 1 or 2 paisa for several days, which is, I don't know when I've seen a period like this before. I can't even recall, because the currency doesn't really become so tight in terms of its day-to-day movement ever since it has become a freely traded currency. I mean, this used to happen in the days when it was a controlled currency, right? When
Right.
you had not really introduced currency trading. So now that it has become a free-floating currency that is traded every day, seeing it in such a tight range shows that the RBI is, putting a lot of control on a day-to-day basis to keep it there, which makes me a little nervous about what is happening in the currency market.
What is happening in the currency market, Rohit? I mean, I think that's a question that all of us have been pondering over, worried about. We've talked about this in News9. But, you look at currency, USD INR closing sort of flattish this afternoon. What is keeping this currency in a very tight, range-bound fashion? We know that RBI is doing the best it can, but there hasn't been much of a cool-off.
Yeah, so I think the RBI is possibly intervening to some degree. That is one reason, because we are close to all-time highs. That means even as the stock market has rallied more than 1,000 points, the USD INR hasn't gotten stronger, which is why, I mean, you typically see an inverse correlation, and the reason is that you always get inflows from FIIs that sort of balances the whole thing.
Right.
But for all of 2023, let's just forget that FIIs have been buying for the last 7-8 days. But on an annual basis, they are still net sellers. The last 2 financial years, they were net sellers, which means this is the 3rd consecutive year that we'll see net selling, even though this year it will be much smaller than the previous 2 years. we basically don't have, the dollar inflows to support our trade deficit, and that I think is the real issue. A year back, if you remember, they sold almost $100 billion to keep the currency from weakening, which is why it did not go beyond 81, 82 for a long period of time, even when the markets were weak in 2021-22. Subsequent to that, we saw some stability, but once again, we've seen it weaken recently. So I think possibly, and you can look at the RBI reserves, they've actually increased at a time when flows are negative. So I think, so the answer is right there. RBI is probably building its dollar book by buying dollars from the market, which is why the currency is not appreciating. Okay, so they're not allowing the little bit of inflows that are coming in are being absorbed by the RBI to really build its reserves, to help them in a rainy day once again.
So it's a catch-22 situation playing out for, the Indian currency and for the RBI at this point. But, talking about India specifically, a lot's going to come in the next upcoming days and weeks. And I want to particularly talk about what happens herein. The exuberance that the markets showed post 5-state elections seems to be waning off in a way, but there are general elections that are waiting in the fray. So that excitement hopefully will build up in the medium term. What's your outlook in the next 6 months?
So I think state elections, central elections, we do draw a lot of correlation based on the last 3 elections. But I do remember in the 90s, there were a lot of studies showing that there's actually no correlation between the two. Many times when the Congress would win the center, they would not win the states, or they would win the states, not win the center, and so on.
Right.
What is good, though, you like, a government to win both, because then you get leverage in both the Lok Sabha and Rajya Sabha, and it's easier to pass bills. So that is primarily the reason to really watch both of them. Otherwise, the results of one do not impact the other. Even then, the markets have read into it positively for now, but that cannot become a reason to predict what happens in the election typically. But I think the sense for national elections only starts after March or April of the year. That's when you have the last 2 months. That is when the markets start pricing the actual outcome, and you can actually read it from there. So that will be a better time to judge what happens from an election standpoint.
Absolutely. Right.
In the meantime, as we head into 2024, we are going to have to deal with the idea that US rates are not going to come down quickly, and there is an economic slowdown globally, and markets will have to try and start pricing that in. So my strategy remains that remain nimble-footed, look at this market more from a trade-to-trade basis, increase maybe cash levels where your portfolio is concerned, so that you can actually buy a dip that comes sometime in 2024. So the investment scenario should be to create some cash for the portfolio as you head into the new year. But on the other side, look at this market as a trading market. Ride this 500,000 points, then probably move out. Be prepared to even trade the short side for those traders who can go both ways. There will be opportunities, I think, on the sell side as well. So we should be aware of that and prepared to do that as and when it shows up. That's going to be the approach.
All right, and while we are at it, let's also take a look at some of the sectoral performance. I'll request my team to pull up that chart. It appears that most of the sectors ended in the red as of this afternoon. Now, Nifty Bank was down 0.5%, IT was down 0.06%, Auto 0.7%, FMCG 0.26%, Pharma again 0.5%. Nifty Metal, PSU banks were up respectively 0.31%, 0.02%. Realty took a beating. Seems like there's some sort of profit booking happening in the realty space. Was down about 1.75%. Nifty Media up about 0.5%, and private banks down about 0.5%. So that is as far as sectoral performance is concerned. Rohit, it is interesting. I mean, looking at realty, which has taken the worst beating in today's trading session, down about 1.75%. We saw a rally that was unexplainable. Nobody understood what's really happening with Nifty Realty. But after all that exuberance for a while now, with numbers not really supporting the kind of exuberance that the market saw, Realty is finally showing some signs of profit booking.
Yeah, the realty market does have a lead lag with equities. I mean, realty doesn't exactly peak out with equity market. In fact, people make money in equities. They end up buying real estate eventually. So because of that, with a lag effect, eventually you find if equities have done well, after some time you suddenly see reality do well. So a lot of this movement, I think, is money into real estate. If you speak to any real estate analyst, they'll talk about a pickup in demand and growth and so on. Having said that, this rally in reality was almost couple of weeks long. We have been seeing the momentum slow down. In fact, our momentum indicator went into sell probably in late November, 28th November. It made one more new high, but I think eventually there's got to be some correction. I'm thinking of the reality index coming back to at least around 675 from where it is right now, around 730. So that's around a 7-8% kind of correction, I think, in the index that is possible in the coming weeks.
I'm looking at the financials and the banking stock also down in the red today. Nifty IT slightly taking a beating at 0.06%. So IT perhaps not weighing in, or weighing in what could come by the way of the Fed's announcement later today. Is it going to be a pause? Is it going to be a rate cut? Rohit, I know you talked about it. You said you're expecting rate cut perhaps not in the first half of the next financial year, in the later half. Is that your reading?
Yeah, I sense it will happen much later because inflation is really not going to cool off immediately. So there are some risks that will delay the eventuality. And Indian IT has behaved very, very differently from US technology stocks that have significantly recovered from the lows of 2023 or from the Jan bottom that they really saw. The Indian IT sector has been actually lackluster. Attempting to move up every time, but really the progress is very, very slow. So it makes you extremely uncomfortable, which is why we completely avoid the tech sector.
All right, then. That's the message coming in. Avoid the tech sector for now. Rohit Srivastava, thank you very much, sir, for taking time out. Thank you for joining us here on News9.
Thank you.
And with that, it's a wrap on Last Tick. We'll be back after a very short break.
The scale of the attack was something that we were surprised at. David Hadley was a double agent. The Americans did not want him to be fully exposed. So all that he probably shared with the Americans was not shared with us in terms of intelligence. If we had that, I'm sure that we would have been able to deal with the situation far better.
This and more streaming on world's first news OTT, News9 Plus. Download now.
Good evening. You're watching Business Plus. The top story that we're tracking on the broadcast, Disney India and Viacom 18 could be merging soon. Reliance Industries and Walt Disney India are in final stages of the deal. As per newspaper reports, both the entities are finalizing details of a non-binding term sheet. Now, Disney India has been mulling a sale of its India TV network for a while. This after India unit lost the streaming rights to the India Premier League, the IPL, to Viacom 18 Media. Now, reports also suggest that Reliance is pitching for a controlling stake with at least 51% stake in the merged entity.